price operates on a price continuum, okay, and it's a efficiency continuum, meaning that the market has to continuously offer fair value, and fair value is evolving all the time throughout the day. And every time it creates a inefficiency like this, it will seek that and go back up into it. Now, it will over deliver just like a paint roller will. The painter will roll back over areas where it's already had paint delivered to the wall, right? You can't just paint one little pathway on your wall and then come over to the left a little bit and come back down and not overlap. You want to overlap. And that's exactly what's occurring in price action, because look at the range in between here. This candle's high and this candle's low. The market has traded down and it also traded up here. So in this little area here, on a micro scale, this is a small little balanced price range. When the bodies of these candles came back up into this fair value gap, that little segment right there, look where the bodies go. See where it stops? The closing price on this candle is 4116.75. What's the low of this candle? 4116.75. That's perfect. That's a signature that shows you the market's algorithmic. My rigid approach to rule-based ideas are my PD arrays within the context of market structure, within a bias that's been derived by a narrative, which is also leaning heavily on a higher time frame premise, which is a weekly chart. I'm doing the same things all the time, but the things I'm doing are very specific, like knowing a very specific level. This candle's low happens to agree with the closing price on that candle. What's the next candle's body? It's the open. It's the same thing. Now, just like that paint roller, when it delivers over top of old areas where it has delivered paint, watch the painter, they overlap over it. Why do they do that? It makes sure there's no seams. It buttons up everything. It completely smooths out and feathers the edge of an old run on paint being delivered to the wall, and then you apply it back over top of it just a little bit. Kind of like when you cut the grass, the lawn, you cut the grass and you come back over, and you're not trying to line up where the edge of the last pass with the mower was. You're going to overlap it a little bit. Why? Because you don't want to waste your time going back there again, right? Well, that's why the algorithm is coded this way. It wants to efficiently go back and reprice. So you'll see these little areas here, which I'm going to borrow this now. Right here, this candle's low and this candle's high. It's passed back and forth between that shaded area, both directions. So when we have this pass back up into the actual fair value gap, that low to that high with this one single candle here, you're going to try to enter in that. Where? Going short at that candle's high or the midpoint in between. You can, if you really want to try to be a precise, fanatic, you can try to get the fill at the high end. But many times I've tried to do that and it doesn't go there. It leaves a small little portion open. In this case, what I'm illustrating here is the efficiency of the algorithm coming back into an area that's already balanced, but it's covering up and overlapping an area where it's already traded to, which is why you're getting this and this. That's not an error. Everything's been offered efficiently, but the bodies tell you the real story. This is where the damage is done, the wicks. But the real narrative and what price is doing is you have to study the bodies. That's where the real storyline is. And you can see how it comes right up into there and stops. This part of these wicks, okay, you have to accept the fact that your trades are going to have that much drawdown. If you're entering in here in consequent encroachment, okay, in this range here, we have what? It's balanced. It's done both passes. This candle went down to this low, and then this candle opened here and then went up this much. The difference between this candle's low and this candle's high, we have this overlapping into this area. What is this entire range? Watch this. If you look at that balanced price range between this candle's low and this candle's high, the range between this low and that high, if we measure that and you get a midpoint level, that is mean threshold. Why? Because we're measuring candlesticks that have bodies. If it were a gap like this fair value gap, the midpoint is consequent encroachment. So over here, we have 4,117.50. How far can it overshoot this fair value gap? Well, what's the midpoint between this candle's low and this candle's high for that balanced price range? 4,117.50. What's the high on this candle right there? 4,117.50. Whoops. So it nails that level perfectly. Then it moves lower and it leaves this area here. One more time, it trades to it, above it. One more time, making sure there's no mohawks in the lawn. It's seamless, and then it breaks lower. One more time, it trades up. What is it going back up into? Consequent encroachment of this gap, midpoint. Hits it. When you see that, as soon as you see that, You're thinking, okay, this is the last time it's going to do it. Why? Because this has already went up to the midpoint of this area here. And why? Because your targets, your terminus, the levels that you're expecting and looking for, that's where it's going to draw to. But when it goes up into this level here, you're anticipating it to do what? Never go back up here. It has no need to do that. But what can it do? What's permissible? It can go back inside this fair value gap. Because why? This is an old inefficiency in price. Whereas this, the difference between this candle's low and this candle's high here, this is efficient. What makes it efficient? It's traded both directions in between this candle's low and this candle's high. So price is effectively permitting balance in order flow in price delivery. Price delivery is every time there's a new price tick and there's a new fluctuation in price action, that's delivery. That's the market being presented a new valuation on an asset. This wick here, we measure that. So that's consequent encouragement at 4100.75. What's the open on this candle here? I'm sorry, I said open. What's the close on that candle? 4100.75. That's consequent encouragement. And the open on this candle is the same thing, 4100.75. Big deal, right? But it goes up a little bit. Why is it doing that? Remember, it's to make it seamless. You're reading order flow. You're weighing out whether or not that the market continuously keeps balancing and repricing, balancing, repricing. So it's permissible for it to trade up to this level here. It does so. So now what has happened right there? From here to here, we had this range back and forth between this candle's high to this candle's low. We trade all the way back up to this candle high, and then we leave the range here. So because this is a balanced price range, why doesn't it have the necessity for price to come back up into that pink area? Why shouldn't it go up there? Because price has done what? It's delivered paint down, then up, then down. It didn't even come back to touch the bottom of the range, which is this old low here, which is what? Classic support and resistance, right? Consequent encroachment of the wick. That's where algorithmic smart money composite men engage right there. And we don't need it to come back up here because this candle went down to this low. And the next candle, it happens to be opening up here and delivers once more over top that range. So what's occurring here? This balanced price range, yes, it's balanced, but now we have a smaller balanced price range here. It doesn't need to come back up into this area. It trades lower and then trades over top of it here again. We leave that range and we come back up. What can it do? What's permissible? Halfway, which is also consequent encouragement of that wick. There's a convergence of factors coming there. When I'm looking at price, my eye's looking at all these things and I'm reading everything from each one of these candles. So when you're watching price, you're looking at it and you're deciphering, does the feedback that you're getting from price supporting the idea that it wants to keep going lower? The fact that we don't go back up into this area is great. The fact that the bodies are respecting the consequent encroachment of that wick and the mean threshold, because we're measuring bodies of candles here, both consequent encroachment and mean threshold converge at the same area, which is this level right there. Look, 4100.75. That's the close and open of that candle. The small little variance in price, you have to allow for that. So now price goes up into that area. We want to see, and I would be saying if we were doing a live trade, I'd say we want to see it deliver and go lower now. It goes down. So what's it doing here? It takes out this low here. So now this low to this high here becomes what? A balanced price range. Because the market has delivered both directions of buy side and sell side. Between this here, our old range, down to this low here, the market trades back up to what? Consequent encroachment. So consequent encroachment becomes the high end of the new balanced price range. Because we've traced back that far, there's no need to worry back to here or this old low. It's already done its work by going back and forth between these two candles. Think about that paint analogy. Are you going to paint the same section of the wall 5 times? No, you're wasting paint. Price isn't going to waste time. Time is important to it. It only has so many trading hours in the day. So you take your eye and your attention. You don't want to do this when price is trading live because you'll miss what you're supposed to be focusing on. But you want to be referring to it while watching price. The market trades back up into this consequent encroachment here, which is now the new high of the balanced price range. There's no necessity for it to trade higher. Does the willingness of price reflect wanting to go lower? Yes, it does. It takes out this low here, and then we come back up. What's permissible? If this is a balanced price range, it's painted price down, offered sell side, then it offered buy side to the area where we're expecting to see price go to anyway. Then it should go lower. It does. It leaves that price range. Can it go back up into this range? Yes. How far? Halfway. Because we're measuring bodies, we're looking at it through the lens of what? Mean threshold. So here is the mean threshold, 4097.50. That's what could reasonably be traded to, and it's permissible. It means it's allowed. You can expect that, and it doesn't upset anything. The market fails to go there, and what does it do? It trades lower than that low now. So we're expanding our range, and it breaks lower. We don't even need to go back up to mean threshold. We're looking for now any further advancement lower. What does this area here now become? Between mean threshold, which was never hit, this to this is your new balanced price range. Does market want to trade away from that? It does. But now we're late in the day. What time of day? 15:24. So it's 24 minutes after 3, New York local time. It's going to run. It's going to aggressively reach to the liquidity it's going to aim for the day. Aggressively runs, trades to whatever 40, 78 and a quarter becomes. I don't even know what that is off the top of my head. In my notes, I don't have anything that jogs my memory to that. It hits it at what time? 15:34. So 34 minutes after 3. And then 20 minutes to 4. You want to be sitting and waiting for price to run on liquidity, because at 15 minutes of, if you haven't already seen it by then, it's going to really aggressively run on liquidity that has not seen or hasn't been tapped into. But reading price and understanding the order flow, every time we have an overlap of price. If sell side's offered, it means it's going down, a down candle. If you're bearish, you want to see that down close candle be redelivered with an up close price movement, and then back down. It does not need to close with an up candle if it was a recent down close candle. So what do I mean by that? All right, say how we have this down close candle here. Say the next candle opened up and we traded up and overlapped all of that and then went down and made a lower low. And so it will have a wick there. That's the same thing as what I'm saying is it has to have both. Every range between one price level and another to be determined and deemed efficiently delivered is between both price points, between any price point range in a price run. It has to offer both directions. It went down and up, down, then up. Or if it starts with up first, it's up, then down. And it has to overlap the entire range of whatever has been delivered. If the market trades back and forth between price points that are defined as I'm teaching you, if they deliver both directions, that's efficiently delivered price. When it doesn't do that, it creates these things like this, where you have a separation from one candle's low, one candle down, the next candle is a lower high than the previous candle's low on these 3 candles here. So a fair value gap is 3 candles. The identification of the inefficiency is always the candle in the middle, and you define it by the candle prior and the candle after. And that segment of price action in between becomes your fair value gap.